When I hear special situation, I feel like it's a hedge fund strategy.
It sounds kind of way out there, and a lot of small investors think that too. Oh, it's a little bit, oh, what is it out there? Special situation, rather than buying Apple or selling Facebook. So essentially what it is, any special situation that anything there is a catalyst within the stock that will move the stock. So that could be a variety of things. It could be hard catalysts such as spin and those sort of things and actual forced moves of the company, or it can be softer catalysts such as management change or some sort of transformational change. I mentioned that before. Very prevalent now, just as a side note, investors probably want to look at that because something like a Harley Davidson, for example, here's a story. I picked that stock up on its knees really, and people said to me, and I said, look, we've got a new guy here. We've got this guy, Joe, brought Puma back from the brink. Puma was about to go in bankruptcy. He brought that back from the brink. He turned it around, and now it's a great brand. They got a shop on Fifth Avenue. Now, he moved to Hog, Harley Davidson. Hog is the ticker, and he said, well, you know what? This is we're going to change this. We're going to change it to electric bikes. And when I sort of investigated, got our analysts on it, I said, this guy started buying stock. He had a great track record of buying stock. He had a great track record of turning stuff around. The fundamentals look cheap. So I said, Jim, no one drives those long-haired guys and those big long-haired motorcycles anymore. No one does that. I said, no, you're missing the point. It's a transformational change of a great brand that's on its knees going towards something, of electric. And I wrote an article at the time, said Tesla, Harley Davidson's a Tesla of motorbikes, and it still will be, and it's becoming that. And you can't buy a Harley Davidson electric bike. You just can't buy one. They're unbuyable. So, and they're so good. So it's transformed that, and I think that that's one of the, you mentioned special situations and what they are. Well, something that people don't see, something that is transforming in the background, something is changing in the background, and something that move the stock from price to value, whether it be a soft catalyst or a hard catalyst. So that's kind of, or you got the other end of the hard catalyst where Universal Music Group, one of the forefront of music, splitting off from Vivendi, great company, and you just create that value by a hard catalyst. So you got two pieces now. You made 15% overnight, 15% plus the run up in Vivendi as well before that, and now you got sky's the limit on Universal Music Group, I think. So, you've got this hard catalyst here and soft catalyst here. So we kind of look in that sort of area where people are not normally looking. And for Vivendi, such a big company, I don't see any news flow on that really. But it's a great event because people don't understand it. That's what.
Yeah, but that's an interesting one as well, because it seems Vivendi has been this conglomerate play, or that it has a discount to its net asset value. Seems to be, I feel like I've heard the story a long time ago, and probably nothing happened for a long time. There, the catalyst was that, but how would you play it? Or would you be sitting in a long position until the catalyst happened?
It depends, and that's what we do with our institutional product, and we have a smaller investor product, which is cancel anytime, $99 a month. But that's what we do. We analyze the situation when it comes up, and before it comes to the spin, when all the Form 10s are put out there. And that's a difficult thing to do for investors. So we analyze that and we say, well, is there any value release here? One, how is it going to be made? And do we get into stock pre-spin or post-spin? So we make that decision in terms of analysis. So Vivendi, we thought, well, hold on, we think there's going to be some value coming on this particular. We are very right so far. So we'll see what else happens. But one interesting one last year, and again, these things go through and people don't see them because there's no fanfare, there's no big IPO. It's a spin-off. It's I'm going to give you shares whether you like them or not. And one last year and the year before, and the continued moneyed winner, if people want to look at a stock, is IAC. Now, IAC, you might say, well, what's that? Well, if I tell you they spun off Expedia, if I tell you they spun off Match.com, these sort of stocks that are spinning off from IAC, it's been a massive money maker. It's like an unpeeling onion. You take off another layer, you take another, and you're getting true value. So if you look at these things very closely, there's real value to be had. And if you don't, you're just going to miss them. And like I say, you heard that story years ago, but you know what? We didn't recommend it years ago. We recommended it because it was interesting now. There's always a story around. And like I say to everyone, everyone's right. It's just a matter of timing.
And it seems to be, so from what I understood, the example you gave about Harley Davidson or your article on Dun & Bradstreet, it seems you're going at the super micro level, not only look at, okay, there's insiders buying, but who is buying, what's the profile of this guy, what has he done before, and things like that. So I guess that is something that, well, it needs a lot of work, but would that be the kind of edge you can provide?
Yeah, I mean, we break our analysis in three ways, George. We look at obviously the fundamental, and people can say, well, I'm better at you at doing that, I'm better in the car sector, I'm better in that, or whatever. We look at the fundamentals, we look at the breakout values, we look at the transformational values, what they become down the line. We look at the technicals where a stock will essentially be either, when the spin-off happens, it's not the same size as the parent stock, obviously, it can be a lot smaller. And that could fall out of an index. If an index fund has that stock, what do they do with it? They just sell it. And that can create real selling pressure, technical selling pressure, which is not natural. And if it's not natural, then it provides opportunity. So we quantify that. And there's the last piece in terms of analysis, as you adhere to, is the insiders. Now, I always say to people, Jim, what was the first thing, or what's the only thing, if you had to look at a company, you would look at the management. Management control what's going on. They come in every day. They're emotional. They're good. They're not good. They know how to turn companies around. They know what P&L is. They know how to get the share price up. And some of these management are very, very good at buying their own stock, and some of them are not. And we have a database of, 20 years, of 30 years of looking at this, where all these people have been and how good they are. Pfizer was one that, I examined, that we popped up. We had some real key people buying stock who had just got things right ever so well in the past, and they were buying the stock way ahead of all the COVID stuff. I mean, the COVID stuff's crazy. Pfizer is a great company, but they were buying that stock ahead of anything, and it was a clue. It was a clue to, you investigated that again. It's on the Forbes blog, why you should be buying Pfizer with the insiders. But they are giving you a clue as to what they're doing. There is no secret in there. If you go out there and you look for this information, it is there. It is public. There's no secret. So people say to me, oh, well, the congressmen are buying this and that, and we don't get the opportunity. You can find all this. This is all stuff we look. And we pick out the bits that are interesting and say, oh, George, he's an excellent buyer of his own stock. He has been forever. Now he's buying this. Okay, we better look what he's doing. So, but then again, Jim, he's not so good at buying his own stock, but he's buying this. Okay, fair enough. So all this stuff is out there, George. It's just making sure you do the hard work, and that's what we do.
Great. And I love that we've talked about so many examples. So now I'd like to zoom out a little bit and consider maybe some broad statements. So one of the things that's widely perceived in the market is that there's no more alpha, because everybody has a lot of information, and everybody, there's so many institutional and now retail investors in the market. It seems to me that what you're saying is that the information is out there, but it's really hard for anyone to fully utilize it, and therefore that there is alpha.
Yeah, absolutely. I mean, I totally agree with that. I wouldn't be doing what I'm doing if I didn't believe in it. And I think you almost know me by now in me when I say that, and I mean it. Look, there's three ways people can make money these days, right? You're going to be faster. Okay, you can be faster than anyone. You can get the information quick and you're going to execute on it, right? You're just not going to do that. Robots are going to be quicker than that. They know that. You see when stock prices go down, the algorithms go, oh, this is cheap, we should buy something, and it goes back up, right? You're never going to do that. That's the first way you're going to make money. Some people got faster systems. Okay, great. Maybe there's a little bit of edge there. Secondly, the second way to make money these days is to know something that someone doesn't, right? And, Martha Stewart did that in Imclone, if you remember, and she went to prison for it. And that's the result of that. So, and the last way you make money is by analyzing something better than the masses, and that's what we do. So we're looking in that pool of special situations. Like I say, you look at Vivendi today. Vivendi is a huge company. There's no news on this spin-off. No one knows what's going on. UMG have opened up huge. If people take the time to look at, or employ us, let's say, look, here's a plug for our product, right? Get to our subscription. You'll get 40 to 50 ideas a year in this space. And this space is a robot can't do it. A robot can't say, okay, we're going to have one company here and then two companies, and this is going to be valued at that. They just can't do it. So what we get is the anomaly, and then the institutions are going to sell the spin-off, and then it's going to become cheap, and then we buy it, and then blah, blah. The robots can't do it. So what we got is a good niche in a space where there's a good hunting ground of corporate change. Because again, management do it. Robots can't analyze what we analyze, and they never have, and I'm not sure they ever will. So we got a niche business in that space. So hopefully that's cleared things up. Like I say, 3 ways you can make money. You just got to be looking the right places and analyze things a little bit different.
I think in the mainstream, it seems like everybody's going quantitative and you've got to have a rules for everything, whereas it appears that there's in-depth and nuance and subtlety. And for example, I've seen a quote about, spin-offs from David Marks from Evermore, that the market is valuing conglomerates at the price of the weakest business, which would seem to be like, as soon as there's a spin-off, it's value aggregating. But I think the picture you're painting is that, well, potentially, but it's all in the subtlety.
Well, that's right. And David's a great guy, and we ate pizza about 2 weeks ago together. He understands things as well as like a lot of the fund managers out there. But essentially, yeah, you're right. Look, it's in the finer detail. You've really got to spot why things are happening, because the difference between, people got obsessed with SPACs, right? SPACs and IPOs. And SPACs, we come out with a study and we said SPACs, this was before the collapse, we said SPACs just don't make any money. And we were on CNBC, it's on our website, and they had the thing, and they said, what do you mean SPACs don't make money? Everyone's making loads of money. I said, they're not. They're not making any money. They're actually underperforming. And then 3 days later, the whole SPAC market collapsed. But people can get fluffed in by stuff which is sold to you. And, IPOs, for example, IPOs, just to make a quick side note here, IPOs are sold to you at the highest possible price to get you to pay the most money you can for a business, all right? Now, does that sound like an investment you want? It doesn't sound like to me. It sounds awful investment. Pay me as much as you can, George, for this stock that is way up there. And Uber was a great one at the time, and I wrote an article before that as well about, it's just not right. So spin-offs are different. There's no IPO. There's no money to be made out of it. So the investment bankers can't sell it. So these things essentially go through unnoticed. And that's what's one of the points that are interesting about spin-offs. They're unnoticed. You're going to get shares in a company you're not. You're going to end up with UMG shares and you're going to go, well, what are these? I don't know. I'm just going to sell them. Or it might be, that's a bit more mainstream, but some of the more obscure stuff, you're going to go, I've got technology coming out. I don't know, I'm just going to sell it. And the stock gets slammed. So that's what you've got to be wary of. And like I say, he's very right in terms of the subtle detail of the spins. And that's what we go down to in our...
And again, if I try to get to a larger picture, how do you build a universe of companies that you will be looking at? Is there certain geographical or industry that you're looking at in particular, or is it purely whatever news or events there are?
There's a couple of points there. One, there's probably around 40 spins a year. In terms of the special situations, probably another 20 on top of that. So 50, 60 ideas a year and we look at. We have a portfolio of about 15 names. We have a model portfolio which our clients can follow or just look for interest. And we run that. So we're generalists. We looked at our data over the last 15, 20 years and we said, well, you know what? Because people said to us, well, first they said, well, what are you good at? A while ago, we said, well, we should have a look at what we're good at. And it turns out what we're not good at is we're not good at commodities, because I just don't understand commodities. I don't understand things, people turn the taps off of oil or all that stuff or metal. I just don't understand it. It doesn't fit to our analysis. So we're not good at that. And we're not good at biotechs because they're so binary, right? They're either 0 or 1. And we stray away from that analysis and we stick to industrials, technology and stuff, and consumer goods and stuff that we're really good at. So I think it's very important to, when you're building your portfolio, to realize, and this goes to anyone really, young or older or seasoned, and to say, what am I good at? I don't have to get good at biotech. I don't have to get good at commodities. I'm just not good at it. I'll settle for that. That's fine by me. I'll just stay away from it. So you don't have to try and get good at stuff you're not good at, really. You just stick to the stuff you're good at and play it. Why not? And that's how we build our portfolio.
And I guess that comes back to what you were saying about, the mind of the trader. It seems easy to just do that. I'll stick what I do. But the media and everything else is selling you something else. It's selling you whatever, biotech today and the news of the IPO tomorrow and things like that. So it's very easy to get distracted.
Well, yeah, I'm not, like I say, I'm never flavour of the month, but I put up a tweet about a week ago. I'm off Twitter this week because I'm so busy, but what I said was there's a couple of stocks out there, VIH and BBIG, that all the small guys are getting into, and they've been pushed by a few Twitter accounts, and I said, this is stuff you should stay away from. And I've got a barrage of people, oh no, this is that, this is going for the moon, you're going to get burned, you're an idiot, blah, 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 and all that. And the stocks have collapsed. And it's, I always say to people, when the media gets hold of something, get out or don't get in, right? If you're in, get the hell out, because when it goes to there, you just got to get out, because everybody's in it. And that flow of information that you talk about that is so readily available to everyone just hits the stock, so everybody knows what's going on. And it's very difficult to have that edge if everybody knows what's going on.
I want to go back to, I'll go back to, the situation, the current situation in the market, which I think is quite different to what it was a few years ago. But before that, I also want to understand how people use your ideas. So, for example, who are they? Are they typical long-only investors, or are they more alternative? And how is the play? Do you offer them advice on, exactly how to enter and exit, or how does it look?
Yeah, I mean, there's a number of questions there. First of all, in terms of our clients, we have the biggest people in the world. We have some of the smallest funds in the world. I mean, they have one thing in common, right? They want to make money. There's no science to it. Everyone says to me, who are your clients? It's like the people want to make money. And as simple as that. No one questions you when you run the fund or when you're running money or how you made the money. It's when you lose money. So that's why it's important to manage your risk. But so that's the first answer. The second answer is we put out ideas specific, and this is where I think is key to our research, specific to your criteria. So if the 100 billion fund comes on and he has 30% of his book in special situations, which they normally do, they need stocks big enough, liquid enough, certain characteristics that they need presented to. So there might be 5 ideas a year for them. But that's fine. I mean, if they execute on 1 or none in the 2 years, that's fine too. So that's our goal. But some of the smaller guys are more interested in stuff coming through, what's really going to give some alpha to them, and we can service those. And then we have the nimble investor guys who, we got to be a little bit more simple with them. I say simple is the wrong word because it makes them sound dumb, and they're not dumb at all. But we got to display the information and present the analysis in our model portfolio. We give them entries and exits for that, and they can kind of follow on that as well. And they've done super well on that. So everyone's treated slightly differently in our clients, and I think that's where it's key, because you can't just pour out stuff all the time, because it's not applicable to everyone. And that's how we work. And we also have our other one, which is good to mention. Our other side, which I look at, is our activist ideas. Our activist ideas are specifically for activists that we look at companies that potentially should break up and they can get in.
All right. And so let's look now more as well about the current market situation. And also, I know you have a retail side of things, right? Do you see that definitely the retail? I mean, we talked about GME and stuff like that, AMC. There's definitely a new wave in the market. Do you see that creating new opportunities? And how does it affect as well, maybe the interest from retail in your services?
I say to people, I think you got to stick to your strategy, and that doesn't mean, do it at any cost, right? I said a while ago in a Business Insider interview, growth is the new value investment. Okay, and it was a year ago, right? You invest in growth, or a year and a half ago, whenever I did it, and that was it. It was looking for value stocks within growth. When I invested in Tesla at 180 a few years ago, pre-split, people were going, Jim, you're an idiot. You're looking stupid. Investing. I said, no, this is a company that's for the future. I'm investing in the growth for the future. They're like, yeah, but the fundamentals, they don't add up, and this and that. I'm like, no, I'm not. This is not a fundamental play. This is a growth play. You're looking at something disrupting down the line. You're looking at an entrepreneur. There was all stuff that went through it. And look, if you project the fundamentals to this, you can get there. So, again, the media will put you off of this because it's not popular. And I don't go with popular stocks. And like I always say to people, and I said this before, when things become popular, you have to get out. Like, I'm never a GME man. I don't know anything. So what do you think of GME? I don't know. I don't know. It's a news-driven stock. AMC is a news-driven stock. I mean, cinemas, really? Who goes to cinemas nowadays? We're going to stream everything. Don't tell me cinemas are going to last. They're not. All right. So, I just don't think that there's anything in that at all. GME is a different, game, I suppose, but I haven't really analysed it because it's just too much news flow. And for most people, and, I don't know this, but I'm pretty sure of this, for most people, they haven't made any money in those stocks and they're going to get whipped about all over the place. And usually the people in those stocks are very emotionally driven and they're going to get stopped very quickly. And I just say to people, stick to what you know, stick to good analysis, and solid analysis. And if you're wrong, then you understand why you're wrong and you're going to learn from it. And that's the key. But don't go with some of these stocks that are just because everyone thinks they're going up or going down or whatever. It ends up pretty badly for most.
So that means as well that the narratives, another thing we hear is that now stocks are driven by narrative and less than fundamentals, or at least the balance is shifting. But what you're saying is that you don't have to participate at all into that.
I never have. I've never chased those stocks, and I don't ever be in that position of chasing stocks because I just don't understand them. If you don't understand something, just don't invest in it. Really simple as that. If you think that because your friend says, Jim, I think GME's going up, they've got a big contract coming through, everybody knows that. It's all in the price. And you're not going to know anything. Like I say, what is your edge when you invest in a stock over the market? What have you got that no one else has got? And that's the only way you're going to make money. Price information is instantaneous. Now everybody knows GME will have that contract. Everyone knows AMC are doing this. Everybody knows that. That's in the price. You're not.
Yeah, it's a bit less clear on Tesla because I think at some point there was a lot of, the day traders versus the hedge fund. There was a story as well. But you say that you were into it, but not at all because of that, not because there was this hype.
There was never any hype. In fact, at 180, people said to me, this thing's going to zero. You got to get out. And I was like, no, like I say, I've been a contrarian at heart all my life, George, and in everything I do. And I think that stocks is perfectly suited to that because you have to say, what have you got over the market? Now, if you work from the basis, and there's plenty of books on this, maybe not plenty, but there's certainly a couple where the majority is always wrong. Work on that basis. Any investor, start with, is everybody in this stock? Look, if everybody's in a stock, there's no one left to buy it. What makes it go up if everybody's in it? And the same on the downside, right? Back in March 2020, I was buying stuff so cheap, everyone was just getting it out. And another story in 2008, March 2009, I remember distinctly. And because here's one the guy should always remember. I was waiting on the market. I had lots of cash. I wanted to bet the house basically on investing in the market, and the wife wouldn't let me. That's another story. But anyway, I waited, and I was waiting for an opportunity. The market was collapsing, and really big time, 2009 March, and I got the Barron's, and I love a Barron's. I've got it here with me anyway. But on that day, I saw it. The small investor is selling. Now that's the last guy out of any trade. And it's the last guy in of any trade. And that could be the people listening. They've probably bought the high and sold the low. And we've all done it, right? But that's the emotional bit that you've got to play on. When that happens, you've got to strip emotion aside. The world's caving in. You think it's going to go to zero. There's your best purchases right there. And the same on the upside. So don't get involved in the masses, really. Like I say, if everybody's doing it, you probably should be almost doing the opposite.
Yeah, great lesson. And just one question as well that comes to mind, which is more on a macro level. Do you approach a slightly different angle between regions or countries? Because the structure of the market is different. So typically Europe, you would say more European, more families, and therefore the spin-off process is different or things like that? Or is it just really company by company?
I think it's company by company. I think, again, you've got to look at the culture of the management. I think, there's more US entrepreneurs, really, who want to drive business and take positions in their own stock. Rarely you see UK people take positions in their own stock. But like, if you're a manager and you expect your company to do well and you can see the earnings down the line, why wouldn't you buy your own stock? So there's that culture that doesn't really do that in Europe too much. There's some countries that do it more than others. But I think it's the same principle, George. I think you've got to look at the business, you've got to look at what's going on and look at the management and the same way. I don't think there's any differences really. I mean, some of these conglomerates in Germany are never going to break up. Some of these family companies, you can say they should be broken up, but they're never going to. And, you know, we've had activists going there and they've just been laughed out the door. It's like, what do you mean? We're not breaking up. That's a ludicrous idea. That's always going to be that on a cultural basis. But I like the US. I think it's entrepreneurial more than most, and it's a good thing to spot for the manager.
Fantastic. Jim, that was great. I think we will conclude this interview here with so much great pieces of advice and information from you. I'll put all the links as well in the podcast description, but tell us where we can find us and get a glimpse of this advice of yours.
I mean, look, if you're that inclined, you can follow my Twitter account. You know, there's a basis of me, what I do personally. My dogs are always put up there because I love them. And there's a few snippets of what I think and my Forbes article. So that's always a good thing just for a bit of social media. If you want to get a little bit more what we do, certainly check into the website, edgecgroup.com. Get a guy to call you, can tell you what we do. If you're a smaller investor, how we do it, and no pressure. And we have a product for this nimble investor which can come off and on at any time, so that's always good. And the institutions, if you're an institution out there and you want to investigate this space, again, we have an affordable product which could help you. And again, check into the website, let us know. Or if you just want to say, Jim, you know, you're the worst person in the world, just drop me an email as well and tell me how bad I am. So there's a few options there for you.
We'll know where to find you. Jim, this has been amazing. Thank you so much. And, you know, I really look forward to read your next ideas and what's coming up next and the pictures of your dogs as well.
Thank you, George. I appreciate it. Good to see you. Take it easy.